Most investors don't lose money because they are unintelligent. They lose money because they buy great businesses at the wrong price. Price doesn't move because of excitement. It moves when forces align. And once we understood that, we stopped looking for stock tips. We built a structure, a 6-layer decision system. We call it the Q6 Capital Framework. It's built on something we define as the Integrated Equity Alignment System. This is not prediction, it's probability staking. And layer 4 is where most investors destroy their returns. We will come to that. Here is what most people see. They see price. Here is what we look for. Alignment. If at least 4 of these 6 layers don't align, we don't allocate. Let's break it down. Layer 1. Business quality. If the foundation is weak, everything above is fragile. We look for 3 things. Consistently high return on capital, not one lucky year. Manageable debt, because leverage hides weakness. And durability across economic cycles. If a business struggles in a mild slowdowns, it won't survive real stress. In IEAS, this is a foundational alignment. No quality, no allocation. Layer 2. Earnings strength. One strong quarter impresses. Consistency builds conviction. We look for multi-year earnings growth, not spikes. Stable margins, predictable cash generation. Anyone can show growth once. Few sustain it. If earnings don't support the narrative, price eventually corrects reality. This confirms operational alignment. Layer 3. Qualified institutional flow. Retail reacts. Informed capital accumulates. We don't chase institutions. But when steady volume builds our weeks, when declines are bought quietly, we pay attention. Because informed capital does deep work for moving size. This is capital alignment. It tells us we are not alone in seeing the value. So far, we have covered quality, earnings, and capital flow. Most strategies stop here. Q6 does not, because this is where mistakes begin. Layer 4. Valuation. Great companies can be a terrible investment. And this is where most investors destroy their returns. Here is the test we use. If growth slows by 20% tomorrow, is today's price still justified? If the answer is no, you are not investing. You are speculating on optimism. Excitement is not a valuation model. Even the best business at the wrong multiple becomes a risk. This is pricing alignment. Layer 5. Structural base. We enter from strength, not chaos. We look for multi-year support zones, long consolidations, periods where weak hands exit. Structure defines risk before we enter. If price breaks long-term structure, our thesis is invalidated. Most investors hold and hope. We hold until structure fails. That's structural alignment. Layer 6. Technical alignment. This is timing, momentum shift, volume expansion, break above resistance. Technicals don't create conviction. They confirm when probability opens. Execution alignment. We don't predict breakouts. We participate in confirmed ones. Here is the critical insight. A stock does not need perfection across all 6 layers. But the more layers that align, the stronger the conviction. If only 2 layers align, that's trade. If 4 or more align, that's an investment candidate. Q6 doesn't predict markets. It stakes probability. If a structural support breaks, we exit. No ego, no attachment. A framework without discipline is storytelling. In IEAS, capital protection is mandatory alignment. From this point forward, every stock we discuss on this channel will qualify under the Q6 capital framework, built on the integrated equity alignment system, not because it guarantees returns, but because it removes randomness. And when the next opportunity aligns across all 6 layers, you will recognize it before most people do. This is Mr. Jain, a friend redefining destiny, turning every fear into fortune.